I know that you're
Great.
working on. Let's talk about this. You did a little piece on, obviously, there's a lot of coverage out there about Occupy, but you mentioned a group of that is started up, sort of. You said analogous to almost Occupy Our Homes, strike debt or debt
Oh,
strike.
yeah.
Let's
Hmm.
talk about that, and then also talk to us to the extent that you can about that piece you're writing about the sort of next bubble that we're going to see. I guess the financialization or bubble of the housing market.
Right. I'm working on a longer story about this sort of next speculative bubble that we're seeing. If you just read straight housing analysis stories of that nature, they'll be very positive in terms of the housing market. And housing starts went up a bit today. Existing home sales went a bit up today. And everybody's happy, basically. Housing is the great success story right now in 2012 of the U.S. economy.
Really? Someone should tell my house that.
That would be exactly what you would hear if you were reading the business pages today and over the last few months. The reality of it is that a substantial percentage, perhaps most, of these home sales are coming from institutional investors picking up distressed properties. Now, they feel that there is maybe a bottoming out of home prices, and they're buying low, and with the purpose of converting them into rental units and selling them at a higher price a couple years down the road.
How do institutions buy that? I mean, what is the financial instrument in which they buy it?
Cash. They're purchasing them.
So when you say institutions, what kind of institutions?
Funds.
Oh, okay, hedge funds.
I'm talking about hedge funds. I'm talking about investment firms, private equity firms. These kinds of groups, not just regular property management groups that are small and localized and in a particular neighborhood. We're talking about national groups from New York buying hundreds of foreclosed properties in Florida at one time.
How do they do that? Like, what is the mechanism in which they do that? They just have like some...
Well, one of the mechanisms is that they borrow money from the big banks to get the working capital to purchase all these homes. I mean, there have been hundreds of thousands. We've talked about, since there have been millions of foreclosures over the last 4 years, there's all this shadow inventory.
Right.
There are these homes that have not been put on the market that banks are sitting and holding, waiting for someone to give them enough money to make it cost-effective to sell them.
And by having a shadow inventory, it makes the non-shadow inventory, the inventory that we can see, it makes it seem more in demand because there's theoretically less of a supply. But in fact...
Simple supply and demand thing.
Right,
and this helps that because if these institutional investors are coming in and purchasing up all of those distressed properties, first of all, because they're purchasing them for cash, the only remaining homes are not in that state, and the price bids up for those. And it also takes all that other inventory off the market, and there are basically more people looking for less homes right now, and that's where you get the price rise, however slight it is. But it's really being driven. I mean, the percentages, I've been told, of sales that are going to these institutional investors are at the similar level of the housing bubble. And now, why is this a problem? It's a problem for a number of reasons. Number one, they plan to convert these all into rental units. They have no expertise in doing this. They live out of the state, complete across the country in some cases.
But surely they must have entities in the state, right? I mean, you don't have
They do have property management entities, but they don't have necessarily a channel with which to see if they're doing a good job or not. I mean, the concern is that you get a bunch of absentee slumlords, and if the property management companies are problematic, they don't actually own the underlying property, so who do you appeal to get things done? That's number one. Number two, and far more disturbing, is that the plan here is that if you get people into these properties and they're giving you rental payments a month at a time, you have a steady stream of income. Well, they want to securitize that income. They want to turn that income into bonds that can then be sold on the market. And they want to have big banks help them in that process. So here we have a situation that is exactly analogous to what we saw during the housing bubble. During the housing bubble, we saw mortgages pooled up, put into securities, sold all over the world. Now we have rental revenue being pooled up, packaged into securities, sold all over the world. We haven't started it yet because the credit rating agencies say, I don't know how to even rate this. But it's possible. I mean, we are seeing the beginning stages of this. We're seeing the discussions happen on how to securitize this rental revenue and package them into securities. And there is a sucker born every minute, I'm told.
Isn't rental revenue, though, is sort of intrinsically more stable? I guess
Yes
it is.
and no.
I guess it is if you have somebody in there, but there's no guarantee.
Exactly.
Okay.
There's no guarantee, number one, that people will stay in there to the degree that has been promised by these investors.
Right.
And certainly, if there's another recession, if there's another problem, you're going to see more vacancies as household formation drops because people don't have jobs and can't afford the rent anymore. That happens too. And if there are just vacancies for a longer period of time, then it becomes a problem in terms of delivering a steady stream of revenue, which is what is being promised here. Also, eventually, the goal is to sell these things. So, if these investors keep pushing up the prices, which are still not at historical levels. I mean, they're still above historical levels, even though the housing market has crashed so much. It sounds crazy, but the bubble was so high that we're still sort of above the historical norm. If this new speculative bubble starts building housing prices up more, you're going to get the similar kind of crash when they all try to go and sell them in 2, 3, 4 years down the road.
And we should say that this is materially different than sort of traditional house buying, in the sense that traditionally people didn't buy a house for 3 or 4 years. Traditionally, I think,
right.
I don't know what the percentage breakdown was.
Bought it to live in.
They bought it to live in for an extended period of time. It was only during the sort of the bubble where people started to buy it to flip it. And these is basically just a huge. This is like we're gonna see a whole new rash of flip this house. It's just going to be like, for 3 years, try and rent it and securitize the rent.
Exactly. And some other problems are the fact that single-family homes, which is what is being bought to then rent out, require more upkeep than, say, apartment buildings, where you only have, a problem in one place at a time, potentially. That's number one. And number two is that when you have all of this, these single-family homes being rented out, if it's so much property, because we've had this just rash of foreclosures. The stat that I've been told is that in the city of Oakland, 42% of all the foreclosed properties have been bought up by these institutional investors, and they're edging out people who would want to buy in those neighborhoods, who are individuals. Because these investors have cash, they seem, it's more reliable to get your full cash value immediately. So they're buying up all these properties, and, one potential outcome of that is that this turns into a giant redevelopment scheme. That entire neighborhoods change, the character of them changes, that there are so many houses on a block that have been purchased by the same investor or the same group of investors that they just completely rip up the neighborhood.
Right, and they could theoretically turn into, you've got just a
algorithm.
tremendous amount of absentee landlordism, which I'm sure correlates into sort of a slow descent of a neighborhood.
Exactly, and there are studies about the differences between home ownership and renting. There are studies about this type of situation in terms of when you have so many landlords like this, especially out-of-state landlords. It's very concerning. We're building this narrative that housing has recovered, or that it's not falling anymore, and that this should be something to look to as a positive for the U.S. economy. But nobody is looking at, well, what does this housing market actually look like, and what does it look like for people living in it? And that's where it brings up this series of questions.
Okay, so in 30 seconds, David, how can my audience hedge against this and make a fortune with no money down?
Well, it would have to be getting a very favorable loan from your local bank and purchasing. It's not necessarily a bad idea for individuals to buy at the bottom of the market and then rent out a place if they have the working capital. The problem is when you get hedge funds involved in it, when you get banks who have a desire to help with this because they're working on the securitizations and they've lent the money to the banks. And what does the end game look like when somebody doesn't pay their rent and it's part of a securitized bond that the money has to get over to the investors who have paid for that securitized bond? What does that look like?
Lower rents, maybe, but also dumpier places, right? Because we put you.
Well,
in here,
I'm saying, what are the threats that are going to be put on people who don't get their rent in on the first of the month when there are people all around the world and people on Wall Street who are demanding that money?
Right.
That's kind of what I mean.
Well, I guess it was the wrong week for me to take a couple of days off. David Dayen, thank you so much for getting us updated on that.